This week, after years of robust budget outlook, the tide has turned. Growth in tax revenues is trending down. That means tough decisions ahead for state budget writers. But what's driving the revenue slowdown? We asked state revenue forecaster Dave Reich in his first Inside Olympia interview. And welcome to Inside Olympia. The song lyric, "Let the Good Times Roll," captures well the last several years when it came to state tax revenue collections. Each quarterly forecast was better than the last, or at least not worse. But what goes up must eventually come down, and the tide has certainly turned. The state of Washington is now facing a projected multi-billion-dollar gap between available revenues and projected growth in spending over the next 4 years. That means state lawmakers will need to find places to cut spending or have to look to taxes. So what's dragging revenues down? What are the biggest risks to the economy? And how could a new president affect the equation? Joining me now, and for the full hour, for his first appearance on Inside Olympia, is the state's revenue forecaster, David Reich, who's been on the job for about a year. Welcome to the program. Congratulations on this new position. Good to see you.
Thank you very much.
Just a little background about you and how you got to this place. You were King County's revenue forecaster just prior to this, but kind of walk us through your career trajectory. What got you to this path and place?
Yeah. So you're correct. Before this job, I was working for King County. I worked there for a dozen years or so, and kind of a similar format the state has. We had we reported to a group of legislators and the county executive and the budget director, and provided forecasts for them for county revenues. Prior to that, I had worked for the city. I worked in the budget office for King County. I also worked at the city of Seattle for a while in the rates group there, and so that was kind of most of my experience.
I got to ask you about your background in civil engineering. How did you go from civil engineering to revenue forecasting?
That's a good question. It was a bit of a career change. So I studied as an undergraduate and actually I have a master's degree in engineering, and I worked for a while as a consultant, and I actually really enjoyed it. But I was really interested in the economy and sort of the kind of grayer questions that I thought would be there, and so I went back to school and got some more education, and then came out, and since that time I've been working in economics, and it's been great. It's been a really interesting and fun and challenging place to be.
The state economic forecast position doesn't come open very often. We tend to have long tenureships. What interested you in this position? Why did you want this role when you saw that Steve Lurch was retiring and the position was going to come open?
Well, it was a kind of a similar role to what I had in the county, only just kind of more zeros on the numbers, I guess. But I was always interested in the state, in working for the state and being involved with the state. I actually worked for ecology for a while too, and I was also, I knew some of the staff members down here, so I knew the good work that was done. Part of the hang up for me is I actually live in the Seattle area, and so I thought, well, I can't commute every day. But since COVID, and we've been able to work from home some, I was able to work it into my schedule. So I thought, this is great. I should take a chance at it and see if I can get this job.
Well, let's talk kind of big picture. You've just delivered your November quarterly revenue forecast, and we'll dive into that. But in a big picture kind of aggregate sense, how would you describe the state of the state's economy as we wind down 2024, head into 2025? We've kind of come out of the COVID years for the most part.
Yeah. I would say the economy is both the national and the state economy are transitioning to a slower growth framework. We're seeing a slowdown in employment growth. But part of that was deliberate, really engineered by the Federal Reserve to try to slow down the economy and get inflation under control. So we've seen that nationally, and we're seeing the same here in the state. Employment growth right now is up about 1% year to date, which is down from our typical growth rate and down from last year, but still growing. We're still seeing that. We still have very low unemployment, 4.7% right now, which historically is low for Washington State. And we're seeing inflation come down. And we just last week got the numbers for our only real indicator for inflation in the state of Washington is the Seattle Inflation Index, and that came in at 3%, which is still a bit above where everyone wants it to be, but much closer and much better than it was a few years ago. So we're seeing an improvement on that front too.
One of the things that we hear a lot is that while inflation, the rate of inflation is starting to come down again, that prices aren't. And in some cases, I think I read they're 20% above what they were pre-COVID or a few years ago. So when you go to the grocery store, your money is buying fewer things, and people do notice that. How does that factor into evaluating the economy?
Well, I think that's absolutely true. That prices have been up over 20% just in the last 3-4 years, and it's a much more rapid pace of price increase than we've seen in the past, and we've all experienced it and lived through it.
Yeah.
And when I talk to people around the state, that's what I hear from most about, is like, wow, prices are up so much, and it is true. Inflation is just the rate of price increase, and so it's good that it's slowing down, but the price level, it
doesn't correspondingly. The prices don't just drop.
They don't drop. Yeah, there might be the odd.
It's a new normal. It's a new level.
Exactly. Yeah. And actually, in aggregate, incomes have kept up with it, but it's sort of hard to see. It's not something you check all the time. Yeah. It doesn't apply to everybody, and so it's whereas price increases do. So it's it feels different.
Would I be totally putting you on the spot to ask for sort of a historical reference here? When is the last time this country experienced something like this, where we saw this kind of inflation, this kind of price increase, and sort of a new level of pricing? Would we go back to the 80s, the 70s?
Probably the 80s, I would guess. I'd have to look for sure, but if we look we were focused more on the state economy and looking at the Seattle inflation rate, and going back to 2000, never seen a slope change like this. So yeah, it's really rapid, and it's a lot to digest, and it hurts going to the store. So
I want to also just begin sticking with the big picture, ask about this notion of whether we're headed for a recession or what the risk of a recession is. And it didn't seem to feature prominently in this quarterly revenue forecast, but it wasn't that long ago that Steve Lurch was sitting here saying, yeah, economists are watching for a recession. That didn't manifest, didn't happen, but what are economists thinking now?
Yeah, that's been, probably back in 2023, there was a lot of angst about it and a lot of discussion about having a recession, and we kind of kept getting pushed back. And really, I think the Federal Reserve deserves some credit. They really they raised interest rates to slow down the economy. The goal was to get better balance, really starting in the labor market. So wages were going up really rapidly. Labor market was very tight, and wages, of course, filter through to costs, and then that shows up in prices. And so getting a little better balance in the labor market was really important. So that's what they were really focused on, and you can see that if you look at some of the data, the amount of job openings began to fall. But there wasn't a real increase in unemployment either. So they were this kind of notion, and people call it a soft landing, this notion of being able to get back to low inflation, and with the Federal Reserve, their goal is about a 2% inflation number. Trying to get back to that without creating a lot of pain in the labor market, a lot of higher unemployment, people getting laid off, and largely, I don't think we're done yet or completely, but they seem to be on path to achieve that, and so that's
so really, the R word isn't being bandied about as much.
We're not really hearing, there's always some sort of background probability a recession happens, but I think we're back to background kind of, there's nothing special about this time as to other times that in terms of probability of recession.
Okay, let's switch to the revenue side of the ledger. And again, I'm going to show some graphs from your recent presentation in a moment here, but just big picture, it can get a little confusing because we talk about terms like there might be a budget shortfall or revenues are dropping. Let's be clear what we're talking about here in terms of what you're forecasting. Are we expecting to see revenues drop below what they have been, or just slow their rate of growth?
Slow their rate of growth is the answer. We're looking at our forecast for growth annually, and we use fiscal years at the state, but regardless, sort of 3 to 4% a year, which is historically a little bit on the slow side, and certainly slower than we've seen the decade prior to COVID. So sort of 2010 to 2019, when we were averaging maybe 7.5% a year.
So we can pull up, and this is slide 3, which is the forecast of funds slide, and it'll pop up here in a second, I think. Yeah. So this is kind of captures that time period you're talking about.
Yes.
And in fact, in the COVID era, we were looking at double-digit percentage increases. So what is the story that clearly we've had pretty steady growth. There was a little bit of a downturn there in fiscal year 24, down about 2%. But what's the trend line or the story that this graph shows?
Yeah, I think the thing to point out is, so if you look sort of pre-COVID, we had pretty rapid growth, but there's some underlying things going on there. We had some new things like the new capital gains tax that showed up. We had the education investment account showed up. There was an expansion of the sales tax to online retailers. So all of those led to more growth than we typically would have seen otherwise. And then on top of that, we were in a kind of a boom economy around here. So I focus a lot on sales tax because that's about half of state revenues, and so we follow that pretty carefully. And at the time, that sort of decade prior to COVID, retail was growing about 6% or more a year, and that's historically fast. And you wouldn't typically see that. Part of that was a big run up. Kind of post-immediate COVID when everyone was buying goods, buying exercise equipment and stuff like that.
Well, and the housing market was also going crazy.
Housing market's going crazy, and every time a house transacts, people buy furniture or place carpets and all that shows up as taxable sales. And then we had very strong construction. Construction grew about 10% a year on average that decade prior to COVID. Which is historically very fast, and that was because we were seeing lots of building, particularly in the Puget Sound area. And construction is a taxable event, so we get taxable sales on those, and so it was a really strong time. So you kind of have both those things going on. We had some additional funding coming through new initiatives at the state, and then this boom economy.
So if we're getting back to 3% and 4% year over year growth, is that what you're saying is more historically the norm?
Yeah, I think that might be a little bit on the slow side. We're kind of forecasting slower growth overall for the economy. There's some longer term, not so much near term issues, but longer term issues associated with demographics, slower population growth and stuff. That all that is likely to translate into slightly slower growth than we've seen before.
I want to pull up another slide, and this is slide number 4, that shows Revenue Act collections. And again, it goes to the point that you've just made, which is growth is slowing. What's important, I think, is to look from 2020 forward. So we had a drop that was kind of right at the beginning of COVID, and then things recovered, and it's a pretty steep and sharp trajectory.
Yeah.
But again, when you look at this, what is the story that it tells as that sort of spike turns into more of a soft curve?
Yeah, it's so you can kind of see pre-COVID pretty rapid growth year on year, and then of course COVID was a time when most of us, I was at the county at the time, but we had the same sort of no one really knew what was going to happen.
Yeah. We thought it was going to be bad.
We thought it was going to be bad. Construction was shut down. We didn't know what we thought. That's terrible.
Restaurants were shut down. Everybody was shut down.
But actually, taxable sales in Washington State grew, and it grew almost 2% that year in fiscal year 20. And then really accelerated into double digits for 2 years, and that was all of us buying stuff because we couldn't go out and do things.
We're stuck at home shopping online, I guess.
Yeah. So if COVID hadn't happened, we wouldn't have seen the levels that we saw in those years. And now we're kind of getting back to a sort of more normal state. People are shifting back to services, and so we're seeing the growth itself is very slow because we had this rapid growth before.
Yeah. Just to be clear, was any of that growth tied to all of the federal relief dollars that we're pumping into the state?
For certain. I mean, we don't have any numbers, but as putting more money in people's pockets, they were using that to buy durable goods, refrigerators, and appliances, things like that. All things that are taxable events for us.
So let's then talk about some of the factors that are kind of driving the current trend, and you've talked a little bit about them. And by the way, and maybe you have this top of mind, but the decrease for the 23 to they budget in 2-year cycles, but they balance budgets over 4 years. So if we look at the 4-year, it's a $270 million decrease, I think, in this November forecast for 23 through 27.
Correct.
Okay.
Yep.
And again, we're talking about that's on a $70+ billion 2-year budget. Yeah. So these numbers are relative. Sales tax. revenues down year over year, and you note that it's only the third time in the last 15 years that that's happened. So let's start there, because you noted sales tax is a big bucket of money.
Yeah.
What's going on? Why would they actually be down?
Well, again, it's just, it's really because the prior years were elevated. We had all this consumption that was happening kind of post-COVID. And so we're seeing that sort of the replay on that. At least that's part of the story. The other part of the story is construction has slowed down a lot. We have quite a bit fewer construction, or quite a bit less construction. We track building permits as kind of an indicator of that. And single-family permits are up a little bit right now, but multifamily are down around 20%. And so we're seeing a slowdown there. And then,
is there a reason for that? I mean, I would think policymakers would be concerned because we need so much more housing in this state. That doesn't seem like the right trend. Is there some barrier you're seeing? Or some reason for this?
Part of it is a lot was built prior to, and so I think the markets are sort of slowing down and sort of taking up that
whatever slack there is.
All the stuff that's coming online right now.
Yeah.
And then, of course, on the commercial side, commercial office,
Yeah,
a lot of uncertainty
empty.
around there. So people, not a lot.
Nobody wants to go build a new skyscraper.
Nobody wants to do that. Yeah. So we're just seeing kind of a downturn there, and it's not a huge downturn, but a little bit lower construction employment, a little bit lower construction sales tax. So I did, to your point about the fiscal year 24 revenues being down. They were down 0.2%. So a very small amount, but it was noteworthy because in the last 15 years, the only 2 years that's happened were coming out of the Great Recession. So. Again, it is just all these factors playing the prior years being so much more elevated than they would have been, and then now getting back to sort of normal a little bit.
Business and occupation tax also lower.
Yeah, it's kind of a similar story. Yeah, we're just seeing a slowdown, and this has been something we've seen for a while now, and we were aware of and have been built into our forecast. So we're seeing slower growth, but and in some places negative, but mostly it's just very slow growth, which is what that chart shows that you had up earlier.
I just jumped out at me that lottery revenues are down. Does that just mean fewer people are playing the lottery for some reason?
That's just more of an allocation in the actual forecast. So it wasn't really necessarily an indicator of any change in behaviors.
Use tax, estate tax, and other taxes are actually up.
Yeah.
Is that right? So there's sort of a little bit of, maybe not an offset, but you've got some things that are sort of in the down category. Others are actually continuing to increase.
Yeah. Anytime we're adjusting your forecasts, they're sort of a little bit up and a little bit down based on actuals that come in, and a little bit about our models change a little bit. But so most of those were relatively small adjustments to reflect that.
What are the trends, and I would imagine this is part of what's also leading to the downturn in sales tax, but around auto sales? I distinctly remember during the Great Recession, the then state revenue forecaster often said, we could just get people back to buying cars, because when people do, that's a good chunk of change for the state.
Yes.
It adds up.
Yeah, so those have been down too, and really that's another factor here is higher interest rates. Any interest rate sensitive sector, with construction is another one, is hit hard when interest rates are this high. So we definitely have seen quite a downturn in auto sales because of that. People, something like 80% of cars are financed. So when rates are up that high, people don't.
For a while, they were giving it away for free. You get 0%.
Yeah.
Real estate excise tax? What's the trend line there?
Real estate excise tax has moved around a lot over the last few years. So coming out of COVID, it boomed over 30% a year.
Yeah, it went crazy.
Went up a whole lot. Of course, the state transitioned to a variable rate which actually raised revenues also. Mm-hmm. But then in 2023 and 24, it fell close to 50% over those 2 years. And so really dropped off because there weren't that many transactions happening. But so far in 2024, we've seen a little uptick in transactions. And so we've actually got a little bit of a increase in our forecast built in for REIT for the fact that we're seeing that now.
You mentioned the low unemployment rate of 4.6%, lowest since March. It is expected to rise a little bit in 2026 and then decline again. I am curious about how the recent Boeing strike and now subsequent layoffs, and they're not all in Washington State, but how does that factor into this forecast?
Yeah, that's a great question. So every time we do an updated revenue forecast, we also have a kind of a big computer model of the U.S. and Washington State economy. And so these are a bunch of equations and stuff that and data that we put in. And so in the case of the strike, we had to, as the strike's happening, we don't know when it's going to end or anything like that. So we have to make assumptions. So our previous forecast in September, we made assumptions about how long the strike would last. But by the time we did this forecast, we actually knew. So we were able to make those adjustments. And, when we look at the employment data, so we just recently received the October employment data, and it's down about 34,000 jobs, which is almost all Boeing. So, but next month it'll come back up again because those folks are back to work. But in terms of the layoffs, we have also, that's another kind of analogous to that. We have to make some assumptions about how that's going to all play out. We know, that's going to be around 10% of Boeing globally, which is about 17,000 jobs. Our assumption is probably somewhere around 3,000 or so will be Washington jobs. It's our best guess at this time. We have another 1,000 jobs built in that might be non-Boeing jobs that are contractors for them. So we've basically adjusted our employment forecast down by about 4,000 in 2025 to reflect that. And then we'll have to adjust it if it turns out to be different. So far, the Boeing is required to file a notice of these layoffs in the state. They just filed one last week, and it was at about 2,200. So we're looking pretty close so far.
Yeah. What is your sort of overall and primary message to state legislators, budget writers, policymakers? You're obviously not setting the policy. They get the fun job of balancing the budget. But to the extent that you are looking at these models, giving it your best assessment, and then trying to advise them on, here's what you should know as you are proceeding with balancing the budget, what is your primary message to them?
Well, I think we've sort of already discussed that, we're in a period of slower growth than we've seen in the past for all the reasons we discussed. Yeah. And so we should plan accordingly, and that's what our budget process does, is try to match our revenues with our expenditures. And so, it's when we do these forecasts, we usually give the lawmakers a kind of our assessment of risk. So things in both upside and downside risk, that things could be better, things could be worse. This is our best guess based on what we see now. Yeah. But things look, relatively stable, slow and steady as of today. It could change tomorrow, of course,
right.
But.
So in that sense, it's not like the state's facing some sort of cliff or some sort of recession as we've seen in the past. It's more just as I said at the beginning, kind of the heyday, the good times are coming to a bit of they're slowing down.
Yeah. Currently, the way it looks today is a little more slow, methodical, pace going forward.
So on your forecast in terms of the upsides, and you sort of weighted the upsides as kind of 20%, stronger things that could sort of change the coin of the realm here, stronger consumer spending, faster interest rate cuts, quicker resolution of global conflicts like the war between Russia and Ukraine. Downside risks, you gave kind of a 25% weight to, and said that that would be elevated interest rates, which push us into a recession, global conflicts intensify, and then you mentioned potential tariff impacts. We do have President-elect Trump coming in January talking about both very high tariffs, we're a very trade-dependent state, and also about deep cuts to the federal government, which could affect federal funds flowing to the state. So these are variables that you can only guess at this point. But how would you factor those in at this point? Or what would you, again, as you're advising policymakers, how should they be thinking about those potentialities?
Well, at this point, we don't really know a lot yet. There was a lot discussed by the president-elect about different tariff options, and some are very elevated and some not so much. And of course, even then, there's still a whole process to get to a negotiated level of what the tariffs actually are. Our main intent was to highlight, to just remind folks that that's something that's important to Washington, because we are a pretty trade-dependent state. About 20% of our exports are agricultural products. They're probably the ones that would be impacted pretty significantly, as they were back in 2018. 40% of our exports are transportation equipment, largely Boeing airplanes. Those seem to get kind of a pass in 2018. But there's just so much uncertainty, and not only on what domestic policy will be, but also how other countries will retaliate, or will they retaliate, and what will that look like? And so we haven't made any explicit adjustments yet to our model on as far as things like that goes, but we will be over time as we see things unfold.
And just before we go to break, I'm curious about the fact that this economy, the U.S. economy right now, is so dependent on tech companies. And, there's a handful of companies that are driving much of the stock market gains. And we've got AI coming online. How is that affecting the thinking of economists when we think about the risks of recession, when we think about uncertainty in the future? There's a lot of antitrust stuff going on now because there is so much consolidated power, and we're talking about trillion-dollar companies these days. Yeah. How does that fit into this conversation? I realize maybe it doesn't fit into the state revenue conversation, but into the economic forecasting role.
Yeah, those are certainly kind of important issues, and certainly AI comes up a lot. The potential there for improving productivity seems vast, and most of the analysis that I've read suggests it'll be sort of complementary for most of us. It'll help us be better at our jobs and make us more productive. If we're more productive, then our economy will grow faster, and that's a great thing. We welcome that. So I think there's certainly a lot of belief in markets that's going to lead us to faster growth. So far, it's been a little hard to see in the actual data, but it's also quite new. So we're still figuring our way out there. As far as the sort of consolidation or sort of the large companies, those companies got large because they were very successful. But there is concern, I think, about their ability to move markets, and certainly in the financial markets, that has been a big driver of equity markets. And if that was to change, then that would be a negative for the economy, as equity markets would slump. So.
And we're not an income tax state, but California is, and their forecast also just came out. And their forecaster pointed out that a lot of what's driving their revenue growth is stock payouts, and high salaries, and bonuses for people working at companies like NVIDIA and Google. It's a different picture here, but is there a line you can draw, or a parallel, or sort of what's the Washington State version of that?
Well, I guess I would say, we do have obviously some very significant tech players headquartered here in Washington State, and those jobs tend to be high-paying jobs, and so that definitely flows through in terms of things like sales taxes for us. Those higher-income people, spend more money on cars and things like that, and all that will kind of filter on through to us.
Okay. We're going to take a brief break. We'll be back in just a moment to continue our conversation with state revenue forecaster Dave Reich. Back after this.
It really is an honor for the Sun Dome to be the host of the largest piece of public art.
Circle of Light makes the building come alive. It really makes the building sing.
Stolen vehicles are a problem. We need a solution. Pursuits are not the solution to that.
Just hit another vehicle.
With the current pursuit law, you could literally have someone steal a vehicle and drive through a school zone actively at 100 miles an hour back and forth, and no one will be able to do anything about that.
Passing by school.
And welcome back to Inside Olympia. Joining me once again is the state's revenue forecaster, Dave Reich. And I want to transition to a new book of business, if you will, for your office, which is to do not just the state revenue forecast for the operating budget, but also the state transportation revenue forecast. Tell us the backstory and how this landed in your lap just in time for you to take over this office.
So I mean, a lot of this transpired before I was here, but prior to this, the forecasts were done by individual departments, Department of Licensing, WashDOT, and overseen by the Office of Financial Management. There was still a quarterly process for forecasts, but it was a little more handled by staff members in the state, and so can't give you the legislative background so much, but there was a bill put out in the legislature to shift this to the process to something called the Transportation and Economic Revenue Forecast Council, which is made up of several members from the House and Senate and several agency directors, to actually kind of oversee this process and have a more formal, more deliberate process that would be more transparent. And so it was sort of this, kind of this as the state's path to develop more transparency in government. And so the bill went through, and the plan was to get this started in September of 2024. And so when I arrived here, and I took the job in January 1st of 2024. So that was kind of a lot of the work in the first part of the year, was to kind of get staffed up and to do this work. And so we now have this process. We have people in our group who do a bunch of the forecasts. We also continue to work with the other agencies like Department of Licensing and WashDOT to do some of the individual forecasts. There's a whole bunch of different transportation revenues that I'm still learning about.
Yes.
And so in September we submitted our first forecast, and it was approved, and we just now updated it again for our first update, I guess, for this in the November forecast.
And I imagine that the thinking is that just like for state legislators who are writing the state operating budget, that those legislators who are crafting the state transportation budget need as good a numbers as possible, and to the extent that it's possible to look into the models and to gain a forecast to sort of have a sense of where things are headed to make a decision making.
Yes, absolutely. I think that's exactly right, and sort of daylight it and have it out so we all know what the numbers are. The sort of ERC process, as I'm sure many people are aware, was created to kind of have this neutral body do these forecasts and on the operating side, and then everyone would use them in the budgeting. And sort of a similar process now here, where we're doing the forecasts, and the TERC approves it, and then everyone agrees to use it for the transportation budgeting part.
Okay, so let's talk about what the trend lines are there. Some of the things that could have had significant impacts, like the repeal of the Climate Commitment Act, did not come to pass. So you can take that one off the table. And we'll show some graphs here too, but can you kind of walk us through the one or two or three key variables that you're watching for, that you look at when trying to figure out where transportation revenues are going?
Yeah, that's a great question. The about half of the transportation revenue is the motor vehicle fuels tax. So this is the gas tax we all pay when we go to the pump.
And diesel for trucks.
And it's just under 50 cents a gallon. And so that's a very significant source for us. And so that was really one that we were focusing in quickly, it was a really important one for us to focus in on, because we were wondering about the changes occurring in fuel use. So that's an important one. Licenses and registrations also add up to be a very significant a number over time. All of our car registrations and everything, our tabs are important. And then we have, the state has toll facilities, we have the ferries, and kind of various other sources of revenue. So all of those kind of add up to be the whole picture.
And I want to drill down on the gas consumption in a moment, but in the big picture, in the aggregate, just as we did with the state revenues, what's been the trend line, and what are the trend lines that are on the horizon so far as your forecasts show?
Well, yeah, that's a great question. The big concern with the transportation revenue was, for us anyway, was looking at the gas tax and whether or not it was going to go down. And so when looking at it, you can see that it appears like it's going to go down.
We can pull this up. This is slide 2, and this is the gas consumption falling faster than in the September forecast. But leave aside quarterly forecast, this trend line is really stunning to see, because you're looking at now to 2034. What's the blue? So the green line is your November forecast. That's the new forecast. The blue was September. So it was already projected to be declining, but now you've got what looks to be a significantly more of a decline.
So the prior forecast, prior to our September forecast, that blue line on there, was still upward sloping. So when we started looking at it in my group, we started talking about the changes we're seeing, and then looking at the data, and we have these models we use to try to forecast the future, and it just didn't sync up. And so as we got into doing the modeling, it suggests that we're going to see a downward decline a decline in overall in consumption, and it sort of stands to reason given all the changes we're seeing, and since we did the September forecast, we have 4 more months worth of data, and it's been down nearly 6% year over year.
Wow.
So very significant drop. And
but we've been saying this for a long time, and states have been on notice for a long time that they're going to have to start to look for alternatives to the gas tax, like vehicle miles traveled types of fees and charges. But it would appear that sort of the "it's going to happen" is now happening.
it seems
It's
that
at
way.
least on the map.
It seems that way to
on the
us.
chart, yeah.
It's what's difficult about it. If you look at that graph, you can see the sort of a lot of the wiggles that happened prior to that.
Yeah.
It looks like fuel consumption, at least in terms of gasoline consumption, peaked around 2018. But then COVID happened, and so people weren't driving, and it dropped a bunch, and then it kind of came up again. And so it was really, as forecasters, it was hard to, we use these statistical models. It was hard to sort of trick out what is real decline in consumption versus just temporary changes because of COVID. And then of course COVID changed our behaviors. So now we're working from home, and so it's a challenging one to forecast. And when we tell people, we say this is our forecast, but we would just highlight that it's pretty uncertain.
Right. Well, given that you are forecasting out to 2034 and it shows this pretty significant decline, how much of that is based on electric vehicle adoption? How much of it is based on expecting gas-powered vehicles to continue to get better gas mileage, or hybrids to be, taking over a greater percentage of the vehicle pool out there? What's leading to a forecast like this?
Yeah, I'd say it's really both of those things. Fuel efficiency is improving for gas-powered cars. I mean, it has been for years.
It has been for a long time, yeah.
Yeah, if you look back 20 or 30 years, every year it gets a little bit better. Yeah. We expect that to continue. But the lion's share is probably the adoption of the EV vehicles.
Which, by the way, is also going to be it's mandated in this state. So you have to factor that in, right?
Yeah, it's coming up really rapidly.
Really rapidly, like the end of the decade is.
In a decade, yeah. It's when you have that moment where you're like, wow, this is going to happen. We're already here.
Yeah. So is that part of? Are you feeding that sort of statutory requirement into your models?
Well, we're feeding in our forecast of electric vehicle adoption, which we're not really out to that term yet, but for the next 5 to 10 years, we have a projection for electric vehicles. We're using that to adjust our fuel forecast down to reflect that. But of course, the EV adoption is very, very uncertain too. There's so many factors that are driving that. Everything from do the batteries get better? Does the technology get better? Does the federal government provide more support? Do we expand the charging network fast or slow? And so there's a lot that has to come together to really know exactly where we end up there.
Let's put the last slide up, which shows the electric vehicle forecast. And it does call or anticipate substantial growth. I mean, this is the opposite story of the gas tax, right? We see the gas tax sort of precipitously declining, and electric vehicle growth. I mean, they weren't even a blip prior to 2016.
Yeah.
And then by 2034.
Yeah, you can kind of see, like, right in 2024, there's a little over 100,000 electric vehicles registered. But in 4 or 5 years, we've got 500,000, and that starts to become a real meaningful
and then
number.
over 1 million.
And then over 1 million, and that's going to obviously going to affect gas consumption, fuel consumption. So it doesn't not unreasonable to expect it to go down over time.
Did the lawmakers have a response to this? Did you see any gaping mouths or shock?
There were, no, not at our TRC meeting. But talking with folks around the state and outside the state, I think there's sort of the recognition that that kind of makes sense that we would see gasoline, eventually go down. So gasoline consumption go down.
What else, as you're kind of looking at this forecast? And again, the story is similar, right? Like, if you're trying to write transportation budgets, you need to expect slower growth, declining revenues when it comes to gas taxes. That's kind of the bigger message, right?
Yeah, one thing we did provide in our forecast was because I was curious with gas revenue is likely to fall over time. One of the things the state did is they assess fees on electric vehicles. So it's roughly typically $225 a year on an electric vehicle. And I was curious to know if you add those fees over time with our fuel tax revenues, what's that sum total to? Because that's kind of an offset to, it's intended to be an offset. And actually, when you do that, at least our current forecast, we actually have revenues, the sum of those two are actually growing over time. Not very fast, like only about 0.5% a year or less, but they are growing. So there's somewhat of an offset happening with the EV fees.
What is the, in terms of just, again, for policymakers who have to make decisions, and they, again, pull the levers, they can decide whether to seek out new funding sources, but do you have the feeling that after 100 years of relying primarily on the gas tax, that a shift or a tipping point is coming, and perhaps even on the near horizon?
Yeah, I don't really have a sense of that. We're kind of just focused on the revenue side of things, and we have pretty modestly growing revenues forecast, and so. To the extent that the states, that's not going to be adequate for the goals that lawmakers want, then they'll have to look at other alternatives.
To what extent, there's all of this federal infrastructure money that's been promised, in some cases it's been appropriated now and is coming to states. Does that factor in to these calculations? Does the, IIJA money?
Yeah, we don't typically talk about it too much, but it is in our forecast, and there was a bump up this last time of about $250 million on federal funding for fiscal year 24. So that's like an actual. So that's certainly good news and welcome. That more money's good, but our forecast overall is calling for relatively slow growth, kind of 1 to 2% on federal funding going forward.
So let's talk a little bit about the office. You've taken over, you've been there about a year, and I'm curious about, you've had to staff up to be able to do this transportation forecasting. You've got people in that office who've been there for a very long time. No doubt you've got some new people, and a long legacy of people who've done this job before you. So coming in, taking a look, what is your sense of how this operation is operating? Are there changes you want to make? Is this a situation where you're picking up where your predecessor left off and it's sort of like, let's just stay the course? How are you thinking about the role of this office, which clearly has credibility? I mean, that's your first test, right? You want bipartisan credibility, and you want the budget writers to trust your forecasts, knowing that they're just that. But where do you see opportunities for process improvement? Where do you want to just stay the course? What are you thinking?
Well, it's a great question. So I've been here about a year now, so I'm always assessing, like, what can we do better? What are we doing well? And I'm first off, just very impressed by the office. You asked earlier about what attracted me to the job, and part of it was that the office had a great reputation, and I see why, being on the inside now. It's a lot of very talented. Shout out to my staff. A lot of really talented people, very committed people who really care about getting the right answer, which is exactly what you want in a forecast team. So I think overall the process works really well, and this Washington's a little bit unique in having this thing, and we've had it now for many years, and it provides this sort of independent body to do these things, and so we're not arguing over the revenue side, and I just think that's really a smart way to do things, and so I'm happy with the process, and I guess my goal, of course, is to maintain that integrity. So obviously starts with doing really good work, but also being true to that spirit of not being partisan or anything like that. Just we're providing middle of the road forecasts, and let the chips fall as it may. And so overall, I don't have not a lot of real process changes. Our big I won't call it a struggle. Our big challenge this year was gearing up for the transportation forecast, because that was new work for us, not new work for the state.
Right.
But we had to build the models, we had to get the people in place, and then actually deliver the forecasts. And I think staff did a great job, and we got it done. And I think there's always, when you're forecasting, you're never done as a forecaster. So these models, you're always tweaking them. Trying new things, trying different things, and so we will continue to do that. That's part of the life of a forecaster.
Yeah, and to that end, I'm curious about the models and what weight you give to different inputs that you are seeing. Have there been opportunities where you've come in and you've said, look, I think we're giving too much weight to this. I'm going to shift a little bit away from that and give more credence to this. Or let's dump that one and bring in this one we were using at the county instead because I like it better. Are there examples like that?
I mean, yes. Obviously, you're trying to let the data explain to you. So you're as opposed to coming in with your preconceived notions of how things work, because you might be wrong. And we're data driven. We want to let the data tell us what happens. And so sometimes the models will give you results, and maybe it doesn't seem sensible. And so you might try different fits. And for like the motor vehicle fuel tax, we've developed maybe 2, 3, 4 different models. Different ways, different variables, just to kind of triangulate around, are these reasonable? Does one model give you a very different result? Why is that, if that's the case? And so that's just a part and parcel of good forecasting in my mind.
And then does the forecast represent the sort of average of those 3 or 4 models, or do you actually give more or less weight?
It kind of depends, sometimes we're a little worried about the input data quality. So we're using these models, we've tried it, but we're not sure that's the best data. So we might pick one or another depending on that. It's a little bit more art of forecasting, I guess. It's not usually typically just a straight average, but you are kind of looking at different models to kind of guide you as to what's a reasonable view of the future.
I'm also just very interested, stepping back to the national picture. I don't know how much you get to talk to colleagues doing similar work in other states, but the headlines I've been seeing of late are all pretty consistent with what Washington's experiencing, which is slowing revenues. State budget writers are going to have to start belt tightening, and in some places it's worse than others. I mean, California has just weathered a tremendous downturn. They're actually looking like they might be okay for the next budget. Longer term, bigger problems. But what are you hearing from colleagues around the country? And again, how does Washington sort of compare from a revenue picture standpoint?
Yeah, I think it's sort of the same as you just said. I'm hearing the same thing, that overall state economies are slowing down, and it's a little bit of a different time. We've been through, really strange time. We had kind of this boom phase, and then COVID, of course, was strange on so many levels, and we've dealt with that kind of public health emergency, where I sort of think of it in 3 phases. We have, I think the first phase is largely done, the public health part of that, and then the second phase is this period after, where we had high inflation because of the responses, and we've had to respond by raising interest rates, and now we're kind of getting back to okay, this is sort of more normal. The third phase to me is the long-term impacts of COVID, things like school children who missed a year of school, or things like that we're going to experience over the long run, and aren't so directly relevant to our picture for our revenues or the state economy today.
And to that end, it's a little strange to be. I'm not having sort of a moment where I'm like, oh, I remember a time that was similar. I remember a time when we were forecasting, or I wasn't. People in your role were forecasting recessions. I've sat at this desk and interviewed people going through recessions. But this sort of idea that nobody is really using the R word, but things are sort of slowing down, and it seems it's a little unsatisfying, right? Maybe it isn't. Maybe it's exactly what you want, which is a soft landing.
Yeah.
But again, with your economist hat on, how should we be thinking about this? Because I'm not sure, again, that I have a real historic marker to sort of correlate this to.
Yeah. Economists have these kind of notions of equilibrium, and the sort of view right now for most economists, including me, is that we're getting back to sort of an equilibrium point, sort of typical growth. So 2% GDP growth nationally is sort of where we think natural growth is. the Federal Reserve is lowering interest rates. We think they'll get to somewhere around 3% or so, and that'll be sort of the neutral rate of, meaning they're not trying to stimulate or slow down the economy or slow down the economy. And so we're sort of getting to sort of this equilibrium, these equilibrium levels, which I don't disagree that it's not super very exciting. But after what we've been through, all the turmoil, I'll take it for a while.
Well, and so maybe this is the disconnect that I'm sensing is this actually seems like a good thing because, as you say, we've been through a lot. And obviously, you're not going to sustain double-digit percentage growth over the long haul. So equilibrium for the consumer, for the taxpayer, that might be good. On the other side of the ledger, for the people trying to write the budgets who have been used to something different, and it may now have to make some harder decisions, this can be viewed as, and in fact, I think we've seen it in some of the statements that have been made, this is not good news. So that's maybe the disconnect.
Yeah,
it's
definitely if you're used to writing budgets back pre-COVID when we were seeing very significant revenue growth, it's a different world in that sense. So it's a slower world, but not necessarily out of what we should be expecting in sort of the long run, right? Because we're getting this equilibrium notion and slower growth overall.
And just because we have a couple minutes left, when economists get together and talk about not just the next budget cycle or the next quarter or the next few years, what are some of the long-term risks to the economy or potential upsides? What are you looking out and sort of thinking about or seeing or thinking might be new variables that you'll be adding to your models?
Gosh, that's a great question. I think it's on the sort of longer term picture, things like the national debt and dealing with Social Security, those sort of fiscal policy issues, not for us, of course, us here at the state, but just at the national level. Those are issues that are coming out of Social Security, likely to run out of money by 2032, or at least not be able to fully fund, I should say, by 2032 or 2033, and that's not that far away. So I think talking about those things needs to happen, and hopefully will at the other Washington. So that's certainly something. I think on the plus side, we already talked about a little bit. AI does hold the promise of potential productivity improvement. You think about what drives growth is productivity, either more work, either we're working more hours, or we're just getting better at it. So if we can get better at it, our economy grows faster. That's higher income, more income to distribute however you want to distribute it. And so that would certainly be a plus. And there's lots of reasons to be optimistic about it. We'll just have to see if it pencils out.
And just lastly, I know you are not a stockbroker or one of the state investment council folks, but the stock market has been doing really well. And again, all things that go up must come down. What's your sense of where we're headed with the stock market?
That's one thing I don't forecast is the stock market.
But it's obviously so closely tied though to the economy.
Yeah.
And again, we would know if a recession hit there could be correlation there. But what can you say about that? How should we be thinking about the stock market in the context of all of this?
Well, the economic fundamentals have actually been pretty good. The earnings have been pretty strong among firms, and so that's kind of what's been a big factor in the stock market. Although something you brought up earlier, which is that kind of concentration issue, still is concerning because there's only 4 or 5 companies that are driving a lot of the growth in the stock market, and so it
doesn't feel like we're terribly diversified, does it?
No, and so that would be definitely a downside risk factor to equities.
Okay. Just lastly, obviously you're forecasting on a quarterly basis, but what are you going to be watching for over the next 3 months?
Well, I think the new administration and finding more details exactly on how those policies are going to shape out. I mean, there still needs to be a pick for Treasury Secretary, which will implement a lot of those things. So, all those things will be factoring into and thinking about in terms of how we might modify our economic model for the March forecast.
Okay, and at this point, again, you are putting more emphasis on maybe some of the downside risks than the upside risks, but not much of a difference. And so that just sort of split the difference here, right? Like it could go either way.
Yeah, I definitely don't have a biased negative or positive bias. I think it's right now things is like today things look pretty good if you're okay with equilibrium. But, tomorrow could be different.
Okay. We're going to stop there. Dave Reich, the state's relatively new chief economic forecaster, revenue forecaster. Thank you for coming in. Appreciate the conversation. Thank you for watching Inside Olympia, and we'll see you again next week.